All right, well, thanks very much for having this paper on the program. I'm going to talk about financing insurance, joint work with Vish. So in economics, typically the way we think about insurance is there's next period. There's going to be some states of the world, there's going to be a state of the world where you might have an accident, or there's states of the world where you don't have the accident. Insurance gives you coverage in the state of the world where you have the accident, and then you pay the premium if you don't have the accident. So insurance is really trade across states. The paper here is about the fact that, of course, in practice, insurance doesn't look like that. In practice, you pay the premium today, and then tomorrow, if you have the accident, you get coverage. So there's an intertemporal aspect, a financing aspect to insurance. We're going to argue that that is actually an important aspect, both in terms of thinking about how the insurance demand side, explaining basic patterns there, as well as thinking about the structure of insurance firms, so the balance sheet of insurance companies. So essentially then, if the premium is paid up front, really what we're going to argue is that insurance should be really thought of as a state contingent savings, okay? And the smoothing over time and the trade across states is going to be linked because of that. We actually think that this intertemporal aspect hasn't received the attention that it deserves, and we think in terms of determining what happens in insurance markets, it's on the order of magnitude of moral hazard and adverse selection, which are the main frictions that we usually think about when we think about insurance. So on the insurance demand side, what we're going to be arguing is that essentially the fact that you have this intertemporal aspect is going to be critical in explaining the relation between the extent of insurance and households' income or net worth. Okay? In particular, we're going to write down a dynamic model. We're going to show that in a stationary equilibrium, what will happen is insurance is incomplete with probability 1, meaning nobody's fully insured. It's absent with positive probability, which means there's some people that don't buy any insurance at all. More importantly, we show that under pretty general conditions, insurance is globally increasing in both net worth and income, meaning richer people are better insured. And it's also precautionary in a sense that I'll make clear. So that's on the insurance demand side. Then on the insurance supply side, this is going to give us a step into the direction of providing a theory of the insurance company. In particular, our insurance companies will have essentially a balance sheet with assets and liabilities. The assets will essentially be collateralized loans, mortgages, if you want, and the liability side will be a diversified portfolio of insurance claims. Essentially, this is the other side of the coin that people pay the premium for insurance up front. That means that the insurance company collects the premium up front, takes it, puts it into collateralized assets, mortgages, which then back their insurance promises the next period. So again, a step into the direction of providing a theory of the insurance firm. We're also going to think about how does collateral scarcity affect this. We're going to show that if collateral is scarce, that's going to lower interest rates. It's going to lead to people being less well insured, and is going to lead to increased inequality. So one step at a time. This is going to be a theory paper, but some stylized facts just to start out. There's a basic cross-sectional pattern where by both income and wealth, richer people are better insured. More pertinently, there's some evidence, although actually somewhat limited evidence, that within household variation of the extent of insurance, where in particular this paper by Fang and Kung shows that it looks at life insurance and shows that households that have negative shocks to their income are much more likely to lapse life insurance. So essentially they reduce the extent of insurance at the intensive margin. Okay? There's similar patterns in developing economies. For example, when you ask people in the developing economy context, why don't you buy rainfall insurance? They tell you, I don't have the money, I can't afford it. Okay? This makes sense in a model where you have to pay the premium up front. A recent paper in the AER by Kazabur and Willis looks at crop insurance, and they actually have an experiment, a field experiment, where they offer pay-at-harvest insurance instead of pay-up-front insurance, and they get much higher take-up on the pay-at-harvest insurance relative to the pay-up-front insurance. And then, of course, in the conclusion, they say, well, of course, the tricky part with the pay-at-harvest insurance is you got to enforce the payment in the state of the world where the premium is due. And of course, that's exactly what our paper is about. It's thinking about a model with limited enforcement that sort of like ties that all together. We have some previous work on patterns in corporate risk management that look similar, but today I'm going to talk about households. All right, so I'm going to write down a model. I'm going to proceed essentially in 3 steps, but the basic setup will be the same. So it's going to be discrete time infinite horizon. There's going to be households. They have standard time separable preferences. I'm going to assume just risk aversion, no other assumptions on the curvature. Some in other conditions, just because I don't want to deal with corners. How am I going to model risk? The way I'm going to model risk is these households, they just have a Markov chain on their income. Higher states have higher income. And the way I want to think about it is essentially this is income net of non-discretionary payments for health shocks, accidents, and so on. Those could be, so income, this is the net income, which could be reduced both because of direct costs of health shocks and accidents, but also because of limited labor force participation, all of which is unmodeled here. It's just a Markov chain on income. All right. So what I'm going to do then is, so what's the basic friction in the economy? It's going to be limited enforcement without exclusion, okay? So this goes back to some previous work Vish and I have done. What you can show in this, so essentially what happens is when you default, so households can make promises, but when they default on their promises, they can abscond with their entire income and some fraction of tangible assets. And importantly, they're not excluded from any markets going forward. What you can prove in this environment is that the optimal long-term dynamic counter can be implemented in a very simple way. It can be implemented with complete one-step ahead markets in error securities, subject to collateral constraints. Okay? So, but for now, in this economy here, you have only income, there's no other good, so there's no collateral. So then, it's essentially collateral constraints in a world without collateral are short sale constraints. So what happens, essentially the idea here is these guys can make promises, but if they default on their promises, nothing happens to them. Needless to say, no promises are credible. So they can buy claims, but not sell them, okay? So given that, of course, so that there are still claims that are traded, for now, I'm going to assume that there's some risk-neutral lenders that are willing to lend. They're patient relative to the households, but they have deep pockets and they're willing to lend at some exogenous interest rate R, which is their rate of time preference. So for now, I'm going to have no collateral and partial equilibrium. I will then, in the second step, add collateral and then close the model in general equilibrium. All right? In general equilibrium, then this interest rate, the fact that the interest rate R is less than beta inverse will be an equilibrium outcome when collateral is scarce. All right. So given this setup, you can actually write the model in a pretty simple way. The household, so we can write it recursively specifically. We can think of the household as having net worth W and being in a state S. What does the household do? Maximize the utility from consumption plus the discounted value of what happens going forward. Every period, household wakes up with net worth W. What can he spend it on? On consumption and on buying error securities. This thing here, what is this thing here? H prime is error securities for state S prime tomorrow. So this is an entire portfolio of error securities. You're buying them from a risk-neutral lender who charges you the probability of the state and the pertinent interest rate. So this thing here is actually your entire portfolio, cost of your entire error securities portfolio, your insurance portfolio, the insurance expenditures. So if you buy error securities for state S prime, then tomorrow you wake up with your state S prime, you get income Y prime. If you bought some error securities for that state, they pay off. That gives you the net worth next period. And the short sale here, the collateral constraints here, no collateral, so short sale constraints, you can only buy these claims, you can't sell them. Okay, so that's the model. Net worth is the endogenous state variable, and that's what I'm going to start out by characterizing. All right, so the model is well behaved, that's terrific. V sub W is going to be the marginal value of net worth. That'll show up later. But for now, let's put a little more structure to get some clean characterization. The structure I want to put is I want to restrict so I can prove some general results, but with a little more structure we get nice results. Let's assume that the Markov chain is stochastically monotone. All that means is that if today I'm in a higher state, then there's a first order stochastic dominance shift about the future. Essentially, if I'm healthy today, it is more likely that I'm healthy tomorrow in a first order stochastic dominance sense. All right, that's all I'm going to do. IID, of course, is a special case of this, so we can also consider the IID case. All right, so what we can show then in this environment is that the marginal value of net worth, it's decreasing in net worth, so that is clear, that's just concavity, and that comes for free. But with these assumptions, we can actually show that it's also decreasing in the state. Okay? Once you have that, you can actually show that insurance is globally increasing in the following sense. First, the household insures lower states because of this stochastic monotonicity. Bad states are bad both because they have low income and the future is bleak. Okay, so they're unambiguously bad. So you insure a set of lower states, and what you can show is that the net worth next period, state by state, your insurance, the set of states that you insure, I say you insure a state if you buy a positive amount of error securities for that state, and consumption in the insured state are all monotone increasing in net worth and the state. Okay, so this is kind of a pretty, at least to us, it was surprising that you can show this actually globally. It's very different from our previous work where we could certainly now provide a general result like this. Okay, so again, essentially, what happens here is that if I'm in a higher state, if I'm in a higher state, so my future is brighter, then I could buy the same portfolio of insurance claims, but because of the first order stochastic dominance shift, it's actually cheaper. Given that, I have some money left over, which I can spend. The way I'm going to spend is I'm going to eat a little more, which reduces my marginal value of net worth, and I'm going to insure a little more. All right. So, moreover, what we can show is if you put a little more structure and assume that shocks are in fact IID, you can actually show that richer households are better insured in the sense that both the variance of net worth and consumption is decreasing in their wealth. All right. So then, what else can you show? You can show that if the household is sufficiently poor, then essentially what the household will do is the household will not buy any error securities, meaning he's going to be completely uninsured. Okay? Essentially, again, because of the temporal aspect, if times are sufficiently bleak today, then I'm not going to. Insurance is state contingent saving, but if I'm in dire times now, I don't want to save even in a state contingent way. At the other end, if for households that are sufficiently, whose net worth is sufficiently high, you can show that even if your net worth is really relatively high, you're never going to insure the highest state tomorrow. From this, you can conclude, because of the monotonicity, that nobody insures the highest state tomorrow. Okay? And so then, putting this all together, you can look at what happens in the long term. In the long run, you get a unique stationary distribution. It's going to live on some compact support. And more interestingly, under the stationary distribution, insurance is increasing, incomplete with probability 1, and completely absent with strictly positive probability. Meaning that even if I'm currently doing relatively well, I'm pretty well insured, but not perfectly so. So if a negative shock hits, I'm going to say, not a big deal, I'm going to eat a little less and insure a little less. If another negative shock hits, and one more, and so on and so forth, what this says is that eventually I will keep cutting insurance until such time as eventually I will not insure at all. We think that's interesting, and I think that's actually like the empirical prediction here is that that there is within household variation in terms of the extent of insurance. There's actually surprisingly limited evidence to date, possibly because a lot of the work on the empirical work on insurance is informed by adverse selection and moral hazard, which are typically static problems. Here there's a dynamic element. This says that at the intensive margins, you should expect people to cut down insurance. So, for example, I would expect people who fall on hard times to switch from comprehensive insurance on their car to collision insurance only, to increase their deductible on their car insurance, to increase their deductible on their health insurance, and so on and so forth. Again, I'm not aware of much evidence to date on this, but I hope that part of the hope here is that this way of thinking dynamically about this intertemporal aspect will get people to start to look more at the dynamics of the intensive margin of insurance within household. All right, so what I've argued is insurance is state contingent savings. So it's a little bit like buffer. The model behaves very similarly to the standard incomplete markets model with a buffer stock savings. Friedman actually was saying, like, well, some people say, oh, so the people who are the people of high income, they save, and the people with low income, they dissave. And so some people say this means the rich get richer and the poor get poorer, and Caesar says that's not the right way to think about it. The way to think about this is just in a buffer stock way. If I'm currently rich, I'm accumulating a buffer stock, and then if I hit on hard times, I decumulate it, decrease it, this save, exactly because I'm consumption smoothing. Essentially, what we're saying here is insurance is exactly like this. The only twist in the plot is that instead of having one buffer stock, I have a state contingent buffer stock for each state tomorrow. And so what happens is, if I'm currently doing well, I'm increasing the buffer stocks for the states tomorrow, potentially even starting to save even for higher states. And then if I hit on hard times, I start to decrease the buffer stocks across all the states. And eventually, if this goes on long enough and I'm unlucky long enough, I'll draw down the buffer stocks for all states and end up having no buffer stock at all and being fully uninsured. You can show now actually one extra thing, which is you can show that the insurance is precautionary in the sense that if you have a mean preserving, think of this economy with IID shocks to make things simple. Suppose you have a mean preserving spread on the economy in which you live. You can show that insurance is precautionary in the sense that you're spending, in the riskier world, people spend more on insurance. Interestingly, you can show this without any assumptions about risk aversion. And it's kind of interesting to think about why. So in an incomplete markets world, of course, if I save an extra dollar, it's going to show up in all states tomorrow. So when I think about how do I value this, it's the expectation of the marginal utility across states tomorrow. If I'm in a riskier world, well, now, will I want to save more or less? Well, not clear. It depends on the curvature of the marginal utility, so the third derivative. Not in our world. Why not? In our world, you can save state by state. So this is a trade-off between consumption today and consumption in a particular state tomorrow. Just risk aversion, just concavity is sufficient for us to obtain this result. All right. So let's put so that's essentially the model without collateral. So now to make the step towards closing it in general equilibrium, let's add collateral. How am I going to add collateral? I'm going to change the environment a little bit. So there's still the consumption good, but there's also durables. Durables enter separately in the preferences. So I have utility from consumption and utility from the service flow of the durable good. Durables can be built at the cost 1. Income process exactly as before. I have this Markov chain on income. Durable goods, we're going to assume depreciate at rate delta. But importantly, they're going to be able to be used as collateral. Specifically, essentially when I default, I keep my income, but I can abscond with a fraction, 1 minus theta of the durable good, think housing, and the rest I lose. And so what that means is I can credibly pledge up to the resale value of my house. What is my house worth tomorrow? Its house size k is worth k times 1 minus delta tomorrow. Up to fraction theta, which is our collateralizability parameter, is what I can pledge. So I can pledge, so my total state contingent loan can, state by state, can be up to that amount. All right, so to make the analysis we did previously pay off, it's actually interesting to, or best to rewrite this as follows. You say, okay, instead of having these state contingent loans, what we can do is the following. Whenever you buy a house, take the largest mortgage that you can, so lever it fully. If you do that, so you borrow everything you can against the house, which means you pay only down this script P here, which is per unit of house, costs you 1. The resale value, the collateral value is theta times 1 minus delta. The present value of that is what the lender lends you. So what you take out of your own pocket is 1 minus that. And then, well, so to implement this same allocation, what you do is you can now say, suppose there was a state of the world where I could borrow 100,000 and I only wanted to borrow 80,000. Well, now I'm telling you, borrow 100,000 and then just turn around and buy a claim that pays 20,000. Right? So why is that nice? Because then I can write the model recursively, and we still have just short sale constraints. Why do we have short sale constraints? Essentially because whenever you bought a house, which was the only thing you could pledge, you levered it fully. So now the collateral is essentially gone. So now it's very simple. Essentially, the only changes are the red ones. You get your house. This is the service flow from the house that you live in. Instead of just eating and buying insurance, you can also buy a fully levered house. So this is the down payment on your house. And then tomorrow, this is the equity value of your house that shows up. But apart from that, the model is exactly the same. So the collateral constraint is still a short sale constraint because I look at this implementation where you fully pledged your house already. Okay, so in addition to the previous first order conditions, you get an investment Euler equation, but it's not essential here. So let's move forward. So essentially, what we show is the properties generalized largely in terms of the characterization. One twist in the plot is, of course, in the world with durable goods, if I'm richer, I also buy a bigger house. I can show that state by state I have higher net worth. I can't necessarily show that I'm actually buying state by state more insurance claims. But what I want to use this environment now for is to think about general equilibrium. All right. So now general equilibrium will be about determining the interest rate R in equilibrium, right? Which so far I've taken as given. And I'm going to determine it to clear the market for collateralized claims. One of the side products of this will be essentially a theory of the insurance company, in particular the insurance company's balance sheet. Okay? And again, this is going to be a consequence of the intertemporal nature of insurance, the way it looks. So I'm also going to be able to highlight the effect of collateral scarcity. So essentially, when collateral is scarce, in a sense that I'll make precise, then beta R will be less than 1, as I've assumed so far, and all the previous characterization applies. All right, so let's see how this goes. For simplicity here, I'll do IID shocks. So here's a stationary equilibrium in this economy. So there's these households. They can eat and buy houses. They can buy insurance claims. The key price that is determined in equilibrium is the interest rate. There's a stationary distribution here on net worth. Households optimize, and then there's a market clearing condition for collateralized claims. I can write it two ways. One, in terms of state contingent borrowing. The more interesting one will be the one where I model it, where I write things in terms of insurance claims and mortgages. And then essentially what this is going to say is the total supply of collateralized claims equals the total demand for collateralized claims, needless to say. So that's what I'm going to want to interpret as a step towards thinking about the balance sheet of the insurance company. So I'm going to interpret the market clearing condition as essentially the balance sheet of a representative insurance company. So how does the balance sheet look? It has, so here are all the houses. They depreciate. This is the collateral value. So this is the total value of all the mortgages in the economy. And the liability side is a diversified portfolio of all the insurance claims of everybody in the economy. Okay? So assets, collateralized mortgages, liabilities, these insurance claims. Again, this is a step in the direction of providing a theory of the insurance company. It's a little bit like there's a recent literature that sort of taken an interest in thinking about how does the capitalization of the insurance company, of the insurance sector matter for their pricing, for their asset allocation, for maybe fire sales, and so on and so forth. But it doesn't really have a theory of how the insurance sector is structured. This essentially is a step in that direction, where essentially what happens here is, right, insurance companies have positive assets, or the insurance sector has positive assets. And why? Again, it's the other side of the coin that insurance premiums are paid in advance. So because people pay the insurance premium in advance, so the insurance company now has to credibly commit to actually deliver in the state of the world where you have the accident next period. The way it does it is it takes the insurance companies, invests them in collateralized assets, which back their promises next period. All right, so now to go to general equilibrium, we can aggregate everything. So the budget constraints are linear, so you can aggregate them. You get reasonable things. Of course, the aggregate consumption in the economy equals aggregate income in the economy equals aggregate consumption plus the investment in capital. I'm looking here, of course, at the stationary state. So we are keeping the capital stock the same by continuing to invest delta K. Aggregate wealth is the aggregate consumption plus the value of the aggregate capital stock. So more interestingly, let's think now about when can we have full insurance in this economy? Okay. So in particular, suppose beta R equals 1. In this economy, if beta is R equals 1, the first order condition for buying error securities for state S prime looks as follows. If beta R is 1, the marginal value of net worth today has to equal the marginal value of net worth tomorrow in state S prime plus the multiplier on the collateral constraint. So it's going to be weakly larger than the marginal value of net worth in that state tomorrow. And this is true for all states. And so in a steady state, then, what has to be true is that this settles down. So the marginal value of net worth settles down. And so net worth is W star is constant across all states. Okay? This is full insurance. All right? If you're fully insured, by the way, the investment Euler equation starts to look simpler and familiar. And this would determine the size of your house. More importantly, though, you can ask yourself, well, when will it be possible to implement full insurance? Okay, well, to implement full insurance, what do I need to do? Well, I need to satisfy all the short sale constraints. Okay? In particular, what happens? For full insurance, tomorrow, no matter what happens, I have to have the same net worth, W star. So what do I need to do? If tomorrow, so what's going to be tricky? In some states, I'm going to have high income. So I have to be able to sell myself down from the high income that I have all the way to the net worth W star. So essentially to the average income. So that's going to be the key. So to implement full insurance, if I have an income Y prime in a particular state, I need to sell the difference between Y prime and the expected income so that I wake up with the same net worth across all states. Okay? So this is the amount that I need to pledge for a particular state to implement this. This is what I can pledge. So the short sale constraint on the purchase of error security say that this has to be non-negative. But when you look at this, when will this be hard to satisfy? It'll be hard to satisfy in the highest state tomorrow. So if I'm really lucky, I need to sell down to the Wells W star. So then I can reverse this and say, okay, so evaluate this at S upper bar, the highest state tomorrow. That gives me a lower bound of pledgeability. If pledgeability is above this theta bar, defined like so, then there's enough, then at the full insurance solution, I have enough collateral to be able to implement full insurance. And so, bingo, I actually have full insurance. Beta R is 1, everybody's fully insured. And then, of course, more interestingly, if theta is below that, so if collateral is scarce, then beta R is strictly less than 1, because otherwise there would be excess demand for collateralized claims. And so now beta R is less than 1, and exactly the previous characterization applies, incomplete insurance, et cetera, et cetera. Okay? So in a picture, so by the way, interest rates that go below 1 are in principle possible. So in a picture, this looks like this. If collateralizability is above theta bar, then the interest rate is just beta inverse. Below that, it's gonna drop, potentially go negative. Insurance, of course, drops as collateralizability drops. There's a welfare loss as collateralizability drops. This, by the way, is comparisons across steady states. The economy, by the way, responds. If collateral is scarce, the economy responds by, on average, building slightly bigger houses. It's like a roundabout way of responding to the scarcity of collateral. It's just build more houses. That effect, though, in the model is small. So the wealth distribution looks like so. If theta is above theta bar, so a full insurance, degenerate at W star, and as we're dropping theta here, the stationary distribution fans out, more inequality, less well insured, and you can see it here also in the cross-sectional standard deviation of net worth and consumption that are higher if collateralizability is low. So what's the point of the paper? The point of the paper is to argue there's an intertemporal aspect to insurance, and we think it's essential. It's essential in terms of telling you about the relation between net worth and the extent of insurance. In particular, it predicts within household variation in insurance demand with net worth, empirical predictions that haven't been tested enough so far. It also delivers, is a step in the direction of providing a theory of the insurance firms as diversified financial intermediaries with a particular asset liability structure. And we think that this is an aspect that has been understudied relative to moral hazard and adverse selection. That's all I have. Thank you very much.